Do you ever go through a streak of trades, some wins, some losses, and catch yourself wondering if your system truly works? That doubt creeps in quietly. You start analyzing every single outcome, hoping the next trade will finally prove your strategy right. And that constant search for certainty is what slowly kills consistency. But what if you could measure your edge instead of guessing? What if you could see in clear numbers what each trade is worth on average? And know that even after a few losses, the math is still working for you. That's how professionals trade with confidence. And that's exactly what we're going to build today. Welcome back to the Trading Psychology course. In this chapter, we're continuing with risk, reward, and thinking in probabilities. This time focusing on expectancy and the mathematics of consistency. You'll learn how to measure the true performance of your strategy, not by feelings or single outcomes, but by data, using R multiples, win rates, and average returns to calculate your real edge. In part 1, we built the foundation, accepting risk before entry, sizing positions correctly, and thinking in R instead of dollars. Now, in part 2, we'll take that logic further. You'll see how to calculate expectancy, track results across a series of trades, and use a simple performance tracker to develop measurable confidence. By the end of this lesson, you'll know exactly how to evaluate your edge, identify when your system is truly profitable, and use numbers, not emotions, to guide your decisions. Before we talk about consistency, there's something important you need to understand. Expectancy isn't about predicting the next trade. It's about knowing what your system is really worth over time. Most traders look at a few recent results and try to guess whether their strategy is good or bad based on that small sample. But professionals don't think like that. They know one trade or even 5 trades mean nothing. What matters is how their edge performs across a large series of trades. Expectancy gives you that answer. It tells you in simple numbers what your average result per trade really is. Here's the key idea. Expectancy is basically the math behind your edge. It shows how much you can expect to win or lose, on average, every time you follow your plan. And the formula is simple enough to say out loud. Your win rate times your average win minus your loss rate times your average loss. That's it. Just 4 numbers that tell the whole story. If that number comes out positive, your system has an edge and the math is in your favor. If it's negative, it doesn't matter how right your analysis feels. The system still loses over time. Let's make this practical. Imagine your strategy wins 40% of the time, and each win gives you 2R. When it loses, it costs 1R. Now plug it in. 40% times 2 minus 60% times 1. That equals plus 0.2R. In other words, your system makes an average of 0.2R per trade. If your risk per trade is $50, that's $10 of profit on average. It may sound small, but that's the essence of professional trading. Small, repeatable edges that compound through discipline and time. And that's where the real power of expectancy comes in. It moves trading out of the emotional world of hope and fear and into the logical world of math and probability. Once you know your expectancy, you stop guessing and start trusting the process. You stop thinking, I need this trade to win, and start thinking, if I keep executing my plan, the math will take care of me. That's where real confidence begins. Not in prediction, but in proof. To deepen this idea of expectancy and show how math governs long-term success, here's David Paul explaining the real challenge behind probability clusters and risk control.
And it's this clustering effect that makes playing the game so difficult, because you get long runs of good trades where you think you're God, and wrong runs, unfortunately, of bad ones where you feel like something that's under your shoe. Now, the first objective is to Live through the clusters arithmetically, that you don't go broke in them. Because you can quite easily have a cluster of 5 bad trades. 5 bad trades happen on a 50% system every 32. So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. The gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So if you've got 100,000 rand in your account and you're new to this, you should not risk any more than 1 to 2% of that in any one trade.
This perfectly connects expectancy to survival. It's not just about having an edge, it's about protecting it. By managing risk and accepting clusters of wins and losses, you let the math behind your system do its work. Now that you understand what expectancy really means, let's break down what creates it. Your win rate and your payoff ratio. These two numbers are like the engine and the fuel of your trading system. One tells you how often you win. The other tells you how much you win compared to how much you lose. Together, they decide whether your edge is strong, weak, or completely random. Your win rate is simple. It's the percentage of trades that end in profit. Your payoff ratio, also called the reward to risk ratio, shows how much you make on average when you win compared to what you lose when you're wrong. A high win rate feels good emotionally. But if your winners are too small, it can still destroy your expectancy. And the opposite is true too. You can win less than half the time and still make money if your winners are large enough to cover your losses. Let's look at a few examples so this sinks in. A trader who wins 70% of the time, but only makes 1 R when right and loses 1 R when wrong, has no real edge. Their expectancy is close to 0. Another trader wins only 40% of the time, but makes 2 R when right and loses 1 R when wrong. That trader has a positive expectancy. The math is simple, but the psychology isn't. Most people chase the comfort of being right instead of building a system that's actually profitable. That's why professionals don't care about being right on every trade. They care about how their average win compares to their average loss. They know a few big winners can pay for many small losses. So instead of asking, how often do I win? They ask, when I win, do I win enough? That single question changes everything. It forces you to think like a risk manager, not a gambler. The beautiful thing is you can balance the two sides. If your win rate is low, you can survive, even thrive with larger rewards. If your win rate is high, you can afford smaller ones. There's no perfect mix. What matters is that your combination of win rate and payoff ratio keeps your expectancy positive. Once you understand that relationship, you stop comparing yourself to other traders and start mastering your own numbers. That's the mindset that builds consistency, knowing your edge and playing it over and over without emotional interference. Even when your expectancy is positive, it doesn't mean your results will come smoothly. Real trading is full of streaks, clusters of wins and losses that can easily trick your emotions. You can have a system with a solid edge and still face 5 or 6 losses in a row. That's not failure. That's just variance, the natural randomness that exists in every probability game. This is where most traders fall apart. After a few losses, they panic, change their rules, or increase their position size to make the money back. But the professionals see it differently. They understand that variance is part of the process. Their goal isn't to avoid losing streaks, it's to survive them. And that's where proper risk management connects directly with psychology. Here's something to remember. The lower your risk per trade, the easier it is to stay calm during drawdowns. If you risk 2% per trade and lose 5 in a row, you're down roughly 10%. That's enough to mess with your confidence. But if you risk only 0.5%, that same streak costs just 2.5%. Uncomfortable, but manageable. Small risk keeps you emotionally stable and gives your edge enough room to appear. Professionals also set what we call loss boundaries. For example, they might stop trading for the day after losing 3R, or take a break for the week after losing 6R. These limits aren't about fear. They're about protecting focus and avoiding emotional overtrading. When your mind resets, your execution improves and your long-term curve stays healthy. So whenever you hit a losing streak, don't let your emotions take over. Step back, breathe, and remind yourself, a few losses don't define your edge. They're simply the cost of playing the game. Your only real job is to keep the risk small enough to stay in the game long enough for the math to work in your favor. That's how professionals turn patience into power. Now that you understand how variance affects your results, let's take the next step, tracking your expectancy in real time. This is where your trading turns from theory into measurable progress. Because no matter how strong your system looks on paper, if you're not tracking results in R, you're flying blind. Every professional keeps some form of expectancy tracker or journal. It doesn't need to be complicated, just consistent. You can use a spreadsheet, a notebook, or any app that feels natural to you. What matters is that after every trade, you record the same key details: the date, setup type, direction, result in R, win or loss, and your running total. Over time, this data reveals your true performance, not your feelings about it. When you record in R, you remove the noise of dollars and emotions. You're not saying, I made $150 today, or I lost $300 this week. You're saying, I'm up 3R this week, or I'm down 2R this month. It's clean, objective, and scalable. Whether your account grows or shrinks, 1R is always the same percentage of risk. That keeps your data consistent and your head clear. To make it even more powerful, you can add a moving expectancy line. For example, the average expectancy of your last 20 trades. When that line stays positive, you know your edge is alive and healthy. When it turns negative, it's a signal to review your system or execution. You're not reacting emotionally anymore. You're responding to information. And here's the best part. This simple habit builds confidence that no motivational video ever could. Because once you see in your own numbers that your system truly has a positive expectancy, the fear of short-term results starts to fade. You stop judging yourself trade by trade and start trusting the process you've proven with your own data. That's when consistency stops being a goal and starts becoming your normal. Let's turn this idea into something you can measure, what I call the 20 trade proof. Pick one strategy you already trade, not a new or experimental one. Then commit to taking 20 trades with that exact setup, following your rules precisely. Same fixed risk per trade, same stop logic, same way of taking profits. No skipping trades, no early exits, and no tweaking the plan mid-series. Every trade is just one data point in the bigger picture. Once you finish the 20 trades, calculate your win rate, your average win, your average loss, and your expectancy. Win rate times average win minus loss rate times average loss. That final number tells you the truth about your system. If it's positive, your edge is real and repeatable. If it's negative, that's not failure, it's feedback. It shows you exactly what needs adjusting. Maybe your targets are too tight, your stops too wide, or your execution too emotional. Either way, you've replaced uncertainty with information. This process does more than show you numbers. It rewires your mindset. You stop reacting to single outcomes and start focusing on the series. That's the shift Mark Douglas described when he said confidence comes from accepting uncertainty. You're no longer trying to win every trade. You're learning to let probabilities unfold across the series. And that's where consistency begins. To illustrate how discipline transforms trading from chaos to consistency, here's a practical lesson from David Paul, an experienced trader who emphasizes mechanical structure and persistence.
To build discipline, folks, you're going to have to grit your teeth and stick to the process. So the first step, put together your trading plan, a simple mechanical plan. The more mechanical, the better. And then my challenge to you folks is to follow that plan without deviation for a batch of somewhere between 20 and 30 trades. Now it's going to take quite a bit of doing, but to build a habit, okay, any habit, you've got to grit your teeth and do it. And then all of a sudden, everybody in this room is 8 to 13 trades away from the trader you want to be. That's all. But very few people get there.
This reinforces the idea that discipline is measurable. It's built through repetition, not motivation. Once you commit to a defined process, the numbers will start to tell your story. Now it's time to make this practical. Open your trading journal or create a simple spreadsheet. Add 5 columns: date, setup, direction, result in R, and notes on your mindset before and after the trade. Then log every trade for the next 20 entries. No skipping, no editing after the fact, no hiding bad results. When the series ends, review it honestly. Write down your expectancy result in bold. If it's positive, keep trading exactly as you have been. Discipline is now your main job. If it's negative, find the pattern. Are your stops too tight? Are you taking profits too soon? Let the data guide your next improvement. And to protect your focus, set a maximum loss limit. For example, minus 3R per day or minus 6R per week. When you hit that limit, stop trading and review. That's not weakness. That's professionalism. Do this once with full commitment, and you'll see what few traders ever do. Your real edge in numbers. You'll stop chasing the feeling of being right and start trading with calm, mathematical confidence. Because once you can prove your edge, you don't need to hope anymore. You just need to execute. Please also remember that you're not alone on this journey. All the material in this course was developed by the ComLucro channel, built on thousands of hours of trading experience and enriched with knowledge from books, lectures, and videos you can also find here on our channel. I invite you to explore our other courses and learn from the insights of world-class traders and coaches like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others we study and share here. And in the next module, we'll go even deeper to help you understand trading decisions and how to align your mind so it works for you, not against you. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.